Friday, kind of a strange week with the market closed on Monday and Tuesday. Haven't seen that since 9/11, actually, when the market was closed for an entire week. And we absolutely have no idea what to do with ourselves during that period. I think I remember, Dr. K, we doing a lot of going out to lunch, I think, long lunches on those
That's right.
days. There really wasn't much to do. I think I spent $20,000 taking so many people in my staff at O'Neill out to lunch that week and trying to keep everybody's spirits up because it was a tough week. Now, this has been pretty tough for you people out there on the East Coast. I hope anybody who's listening, if you've been out there, hopefully you're doing okay. My mother-in-law is actually in Hawthorne, New York, about 25 miles north of Manhattan as a crow flies, and just east of the Hudson River around Sleepy Hollow. So for those of you familiar with that area, but she just moved back to New York a couple of months ago after having been in California for about the last 10 years. And I'm sure she's not too thrilled about being back there because they have no electricity right now, and they don't. They're being told they're not going to have electricity for another 5 days. So it's been a tough few days for a lot of people out there on the East Coast. The market itself did what it was looking like it wanted to do at some point in here. Is basically bouncing off of on the Nasdaq. What's going on here? Let me pull this guy off. On the NASDAQ index, you can see just coming off the 200-day moving average. You had a pickup in volume on just slightly on Wednesday when we reopened for trading, and it held. So you could have viewed that, I guess, as short-term support. But remember, we also have this area over here on the left side, this jagged area that is also coinciding with the 200-day moving average as a supporting level for the NASDAQ. So it's logical for it to bounce, but the bounce is not that convincing to me, at least, because you're seeing a lot of leading stock continue to act poorly. In fact, you watch Apple yesterday not moving really much at all on a day where the market indexes are jamming to the upside. So I think Apple's
it's just about to cross through the 200-day, actually, as we speak.
Yeah, and where is the 200-day right now, Dr. K? It's at
589.
589. Yeah, so you're coming up to right now 589.97. You can see this is my game screen here, as we might call it, but I put out several.
590. It's at 590, so it's just below the 200 right now.
So it's now breaking through it. So.
But it's not. The low was 588 and 73, and it hasn't gotten down to that level, but it's testing it.
Okay. So where were we? Let's see. I put out some shorts this morning. As you know, I'll try and short into any bounces or rallies, and I've basically been keeping it to a very simple strategy because what I want is one-click gratification. I want to be able to move very quickly. And yesterday I did have to move out very quickly because the market was up and it never really gave it up. You see on the NASDAQ closing at the peak yesterday, and I had some short positions, but I basically flattened them out going into the close, took a small loss, about 1.5% on the day, but I've had several up days that have been pretty significant, so I was very happy to pull out on that. Now this short-term trick that I'm using, and I showed you guys last week, has been very helpful in keeping me out of trouble. I know a couple of you have emailed us telling us that you're using something like this to keep yourself disciplined and not let your emotions or your pigginess get the best of you when things are headed to the downside. I can tell you one thing, in my view, the only side to play on this market right now is the short side. You can pretend, that some side. Well, you don't have to pretend. And there are some stocks acting okay, and they're holding up in bases. But I think, as we saw this morning with Coors, the breakout today has now reversed. And I'll show you later how I got a short sale signal on the stock, and I'm actually shorted. I didn't buy into the breakout. Kramer was on last night pumping the stock, and I think that may have caused a gap up. But it looked pretty good this morning, and Coors has been holding up very well. But I can come in with this short-term system that I'm using and come after it on the short side. Or even if you bought the breakout this morning on the gap up thinking it was going to be a big move for the stock, you would have been blown out very quickly. So I'm just going to go through the indexes here. Okay, we got the NASDAQ, and it's coming down. You got a descending trend line here right up to the top. Boom, heading lower and rolling over. Are we trading heavier volume right now, Dr. K?
Let me check here.
Someone says they sold all their Coors at the top this morning. Brilliant move. Something I want to point out is that institutions don't buy breakouts, okay? So if you see a breakout, you have to think to yourself, are institutions creating that breakout? And for what purpose? Are they accumulating stock? Are they in the general mode of accumulating stocks right now, or does it look like a lot of stocks are under distribution? I would say a lot of the stocks that have been the leaders are under distribution, and I know firsthand a number of big institutional guys from my days at O'Neill who would frequently sell into breakouts when they were in the process of distributing stock, and sometimes they would even create a breakout in order to sell into it or to give them some cover to sell into. And remember that charts really are not something that institutional investors use. They don't buy breakouts. They don't buy on the basis of technicals. They may create breakouts, but they certainly don't sit there and say, oh, look, a breakout, let's all jump in and buy it. No, that's what we do it, because our method basically follows in the footsteps of institutional buying. And I would say that also goes for the short side as well. So if I feel the market is in a distributionary or distributive phase, whatever you want to make up to basically say that the market is under distribution, then I'm looking to short stocks on rallies, and I think in a case where you have breakouts, they're more prone to failure than success. So that's all best determined, of course, in hindsight, as always. But I think the bottom line here, market in the downtrend, rally up into this area of resistance on the upside, along with this downside trend line on the NASDAQ. Bingo, bingo. I think you're short until you see some sort of breakout through this line. That's on the NASDAQ Composite. If we look at the S&P over here, what you see happen here is, yeah, you come down close to the 1400 level down in here. You get support off the 1400 level. And, you know, this didn't have to produce a bounce. It could have just as easily been a bear flag that produces a breakout to the downside, because it looks like all you did here was bounce right up into the 50-day moving average here. And you're rolling back over. Is volume higher again, Dr. Catford? I don't know if I was.
Yeah, so we're a little higher on the New York and a little lower on the Nasdaq.
Okay.
So it's pretty close right now in terms of volume compared to yesterday's levels.
Right, now the market direction model is on a neutral signal. You want to explain any of that and what you're thinking?
Sure. Yeah, I mean, when we're on a neutral or sell signal, if any stocks like Coors come up that have exceptional fundamentals and the technicals have been strong, you're better off, if you're going to buy it all, you're better off doing a half position at most, just because we're in a tenuous environment. And you can see that in terms of the action of leading stocks and the price volume action on the majors. The downtrend is still intact. However, it had a bounce yesterday, and this bounce can sometimes persist. You can call it a QE bounce for a number of days. And a stock like Coors that tends to buck the trend, this downtrend, which also had a pocket pivot, almost a pocket pivot yesterday, and that was without Cramer's announcement, is more prone to outperform. If the market actually does have a bounce here, it's probably going to go higher. That said, you got to keep your stops really tight in this market, because if the market rolls over, the model is going to go back to a sell signal pretty quickly. On the other hand, if we do get some sort of follow-through day action, then we'll probably be on a buy signal. But we need to also see the action, confirming action in leading stocks.
Yeah, and I would say in general, you're not seeing too much of that. There's a few stocks trying to act decently. I know I saw yesterday somebody was flashing me. We got the markets, general market situation down, so let's look at, whoops, somebody was flashing me Triple D. Get rid of this line here. Okay. What's going on here? Yeah, Triple D. I mean, you had a gap up here. I guess that could have been a viable gap up. We didn't put this out as anything, mainly because we don't really care much for the stock. It tends to be very squirrely, even on an intraday basis, and so it's not something that we've really been into. So, yeah, that's trying to break out, but it's coming off the low end of the base, and that, to me, that seems like it's prone to at least pulling back in. Stratasys was also trying to act better yesterday as well. And we can see today, you know, it looks like it's active, and then boom, they whack it on heavy volume. I think they came out with earnings. I'm not sure. Yeah, they did, and so it wasn't enough to wow the street. And we're watching Apple heading for that 589 level again. So, you know, what is there to buy? Not much. You could see V. Some people ask about V. Okay, what are you going to do there? Are you going to buy that? Here's like a pocket pivot, slightly extended from the 10-day moving average, but you know, are you going to buy that? Every time V has run up, it's pulled in, run out to a new high, pulled back down, now running out to a new high. Market in a downtrend, I'm not a buyer. Are you, Dr. K?
Not at all. Not in. It has to be really an exceptional stock, and then if I'm going to buy anything, it's going to be a small position. And for the record, I haven't bought anything so far. Nothing really is that enticing to me.
No, it's not really. So, okay. I was thinking maybe you had piled into Coors at the top or something, but no, huh?
In the old days, I used to always pile in at the top, but then the stock would keep going.
Yeah, exactly. You know, and you can't really do that in this environment. It throws you off. So, you know, getting
You
to
got to be more careful.
my little system I showed you guys last week, and given that this is a tiny community of, I don't know, what do we got, 300, 400 webinar subscribers, so we get to, you guys get to see some of the crazy stuff we come up with. But this one, let's just take a look at Coors. I would say, even if I was looking at this morning, of course, and thinking, am I going to buy this? You know, Kramer was out saying buy it yesterday, so that's always good for a little pop, and it wasn't that much of a pop, maybe 2-3% this morning. But even if you had bought it, if you're using a simple intraday indicator to keep you out of trouble, it broke down very quickly. You can see the MACD breaks down here. I make these nice and fat lines for my aging eyesight to be able to pick off really quickly. But you can see here's the sell signal here, and you can see some heavy volume come into the stock on a 5-minute chart off the peak. And the big volume was right in here, and that looks to me like it was clearly sold into. So once it breaks like that, if you did test the position, you could have blown out quickly. But I'll come in on the short side, and I'm short the stock right now. Now notice that we're getting a little bit of a buy signal. I'll let that run a little bit because I'm up on the stock pretty decently, so I'll just wait and see what happens. If you were running it really tightly, you could take your profit cover and then wait for it to break down again. But I've got a pretty good cushion under me right now, and I'm willing to let these play out just a little bit more, you know, maybe 1% or so and beyond at the most, and keep it all under control. And so far I've been able to do that pretty well. But that's what I'll do in terms of the short side. You can see that we got another signal from Google earlier, so I've been watching all day. I'm now short the stock, and it's starting to break down. The other thing to keep in mind here is it's at the 65-day exponential, this black line, which is what I use. Sometimes on the short side, I just notice that stocks will have reflex rallies up to that level and sometimes to the 50-day, but a lot of times if it stops before the 50-day, it's generally hitting the 65-day exponential, just an observation, and it has worked, and it's coinciding with this sort of rollover. So I short into this rally this morning on that one. Baidu, the same thing. They open it up. It's shortable almost immediately. Now, you notice you did have a little buy signal, but as I see it here, this area up in here is going to be resistance around 107, so as long as it can't get above there, I'm okay staying with it. But that initial signal is what gets me in. And generally that'll work, and if it fails very quickly, I'll turn around. So let's say if this yellow or orange line turned back up, I'll turn around and I'll just cover very quickly and get the hell out of the way. And that's the way I operate on the short side. I don't really let things get out of the way. And I devised this method to, number one, short into rallies, and number two, tell me when something perhaps is extended to the downside and ready to reflex rally back to the upside. And those are really my problems on the short side because I like to play it very heavy. And I would say if you are going to play on the short side, you better expect to take some heat. Sometimes that's just the nature of the game, and particularly if you like to play it as concentrated and heavy a manner as I do. So really what this does is keeps me out of trouble, and it's just a very simple method to keep me outside of my emotions and keep me rational. I'll just show you an example. Yesterday, I got short Baidu off the open again, and it opens up into the 107, 108 area, and you can get short. This is a 5-minute chart going yesterday, as you can see the date here. 6:30 a.m. is when the market opens my time. So you get the short signal, boom, 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 it breaks down. Now you see it turn off the bottom, and here's your buy signal. And if you got a decent enough profit and the market looks like it's up and it's gonna turn, you just cover right there and take your profits on the day. So it's almost like a day trading system, sort of. Only in the sense that if it makes me blow out of something very quickly, I will blow out of it, and so it will become a day trade. If I can set up positions into these rallies over time and hold a core position and set that up and get a cushion underneath me, I may sit overnight with some short positions. But mostly, for the most part, I'm sticking to 20-30% overnight, if that. And I generally like to come in with cash most of the time if I think the market's in rally mode. And this morning, we were in rally mode right off the opening. We ran up a little bit, and now we're rolling over to the downside. Dow's down 43 points, and I've got a number of these short. Apple is another one that's been pretty nice to me on the short side. You had a nice signal today. Yesterday, you had a rally up above 600 and a nice signal again. Pick up a few points on the downside. You can see when you get the buy signal again. Now this morning we come in, rally up again, and it breaks down your short. And now you could be you could have covered in here, but I won't do that. If I get short up around here, I'll give it a little bit of room, because a lot of times they'll do this and start to roll over, especially if the market's going down. Now, if the market were rallying and Apple does this, and I might be prone to at least taking some profits, cutting my position down, because right now I'm running, basically 100% position in Apple right now, and short 100% position in Google, and short right now about, I'm going to say 30% position in Baidu, and maybe 20% in Coors. So, those are the real big ones, and I like that. I like to run these very heavy because I can get out very quickly. You two clicks and you're short 2,000 shares of Apple. That's $1.2 million right there. So you can deploy funds on the short side very quickly. Okay. And some people have asked me, do you like to short high-priced stocks or low-priced stocks? I like to short whatever I think is going down. So whether it's a $30 stock or a $100 or $600 stock, it doesn't matter to me. I don't look at it in terms of prices. I look at it in terms of the amount invested, and with these stocks, with Google, Apple in particular, I can get invested very quickly a large amount with just a couple 3,000 shares, rather than trying to work 10 or 20 or 30,000 shares of a $30 stock. I would note, looking at some of these. Now, notice here on the 5-minute, Apple's undercut the previous low from earlier this morning, and if it now what might occur here is you could have undercut and may turn back. So I'm watching this, and we'll see how this pans out. Let's take a look at Google right now. It's now rallying back up to this 20-period simple moving average, the blue line here. So I'm kind of watching that. You got the MACD crossing here, but that's neither here nor there. If I'm shorted up in here right around 693, somewhere, say 694, then you got 0.03%. It's really pretty tiny, but we'll see how this works. But I've got everything on a very tight leash, and that's how I'm working it. Coors was, I think I already talked about that. Now it's kind of weakening. I don't know. I think this is a failed breakout. I would be wary of the stock, and I would not assume that it's necessarily going to hold up. So you don't want to just buy it blindly. If it does break the 50-day moving average, it held on very little to no volume down here. You can see that. And when the volume picks up, it's already up 3-4 days, and to me that seems suspicious. And every time it has rallied up in here, you have seen it sell off. So this is a third attempt here. If it doesn't hold, I might say 3 and out. Use the rule of 3 to say that this thing is going to break the 50-day moving average. But the stock has been a champ. It's got great earnings and sales growth. And I know somebody just IM'd us that they dumped the stock this morning near the highs. So I think that's pretty smart. And they say, thank you, Kramer. Make sure you send him a booyah, whatever you do. Anyways, that's been my approach on the short side. Some other stocks keeping an eye on is Bed Bath & Beyond. There was a breakout. We talked about this, I think, last week or the week before, watching this up in here, and it's broken out to the downside. Where does it go from here? I guess I'm looking at, let's see if I can find my weekly chart, somewhere in here. Here we go. Here we are. I guess you're flirting with a lot of these lows. Maybe this low, maybe ultimately this low. It's going to depend on where the market goes. If the market doesn't blow apart, then maybe it just undercuts these lows in here, and that's pretty much it. But we'll see. So that's another one I'm looking at. Lulu, I think also, you got this here's this big cup. This is a weekly chart again. Big sloppy base, breaks out, fails on the breakout, makes a big sloppy cup. There's no real big volume off the lows, and that's what I think is suspicious. A lot of times on a valid cup, what you see is some big volume spikes along the lows, which basically confirm some institutional support along the lows. I don't really think you're seeing that. You do have this big rush here, but I think that's more short covering. Lulu has had pretty decent short interest. So, that so far that's, let's take a look at a daily chart here. Where did my daily charts go? They're down here somewhere. Here we go. Bingo. And you can see what happened today as you rally right into the 50 days. So I think this becomes shortable here using the high of the day at 72.35 as a stop. So that's about $1.50 away from where we're trading right now. TIBAX, this was shortable in here. I think we put it out with a 27.70 something stop, and it's rallying right back up into resistance. Might become shortable in here. But you notice you did just undercut these lows, so it was coverable. We were talking about testing the 25 level, and so it's coverable on that basis. And so far, it's bounced up as you might expect. It is down a ways, so I'm not sure if this is really where I want to go. On the short side, I'm just focusing, as I said, on these big NASDAQ stocks, because I think if the NASDAQ is going to blow it, it's going through the 200-day, and I want to be able to play that in a manner that also allows me to bail out very quickly if I have to. So, but we'll see what goes on. You know, the QE ferry is out there. I'm seeing some of these stocks trying to turn. Look at Google coming up and around. So this might be a short-term cover point. I don't know. We'll see what happens as we go through the webinar. Let's see, some questions. We already talked about the S&P Mid-Cap Index had a follow-through yesterday. Why bother, I say. You going to pay attention to follow-through in the S&P Mid-Cap Index, Dr. K?
No, not really. Not something I look at normally.
Can you discuss the PPR on WPI? PPR and WPI. Okay, there it is. What PPR? Oh, did we put something out on this yesterday? I mean, it was a pocket pivot.
Yeah, it's good earnings report.
Okay, you can talk about that?
Yeah, sure. I mean, it's just a classic pocket pivot, but of course, you know, we are in a downtrend, so you know, any buying has to be done with caution. You know, overall, the stock is, you know, it's a big cap stock that's actually managed to buck the downtrend in the market. It's actually gone higher, and it had a gap up that was a viable gap up on August 24th. So it's got a lot of good things in the pattern. Actually, it's had a couple gap ups on good earnings. So if the weight of the market comes off here, this thing will probably go higher, is my guess. But that's the question. Where's the market going to go from here? The model says cash right now because it seems like you might as well flip a coin because there's equal argument to a bounce versus a rollover. Yeah,
and I would say on the short side, mostly playing it with stocks, and I think that's the way to go after them. Because even, you know, on a day like yesterday, Apple was weak despite the fact that the market was rallying like mad. It's also, to me, something of a clue regarding the viability of the general market, I think. So without knowing how long this bounce will last, could be 2, 3, 4 days. Could be yesterday and it's out today. We'll see by the close. You are just kind of waiting and watching in terms of the indexes. But I think with individual stocks, if they're going to rally up in areas where I think they're shortable, I'm going to go after them and do so in a very disciplined manner. Somebody says Citrix had a pocket pivot yesterday and seems to be, what? It looks like it's reversed. Doesn't look like it's holding okay to me. It looks like it's reversing. I don't know. I don't care for this stock. It's kind of thin, relatively thinner, trades less than 1 million shares. I don't know. I think a $50 stock that's really an institutional stock should be trading well over 1 million shares. So I'm not really a buyer of this. Are you, Dr. K?
No, it's not something I would be interested in at all. And it's been a kind of a squirrely stock in general, so it's not something that I get excited about. It really has to redeem itself. As you can see, it tends to undercut the 50-day a number of times in its pattern.
Yeah, I'm getting questions about why do you use 24-hour charts for the short-term short trades. I think I kind of explained that in detail right now, so unless you were not paying attention, I don't really feel like I need to go through it again because you can go look at last week's video and I explained this particular system and I just told you why I devised this in my short-term trading. So, you know, unless you need me to write out some rules or some involved reason as to why I use this, it just gets me in and helps me time my trades intraday. So I've just shown it to you guys. But see, that's why I hate showing anybody this stuff because now everybody wants to take this and turn it into something bigger than it really is. And all it is a very simple timing mechanism that I devised. And as I told you guys last week, it may be different next week. It's kind of depends on what the market's doing, and I will adjust it according to what the market's doing. And so this isn't something hard and fast. And it's not a 24-hour chart. It's a 5-minute chart. So it's just showing me 5-minute intervals for as long as I want to go back. You know, I can go back forever and look and see how this thing trades on a 5-minute basis. So, but that's how you enter short positions and then control your risk by having it kick you out very quickly if the market turns and rallies. So, anyways. Oh, come on. You were saying what? You are getting your sell signal. What is your sell signal? Why is it a sell signal? You got the six period drops below the 20 period. That's my sell signal because I've observed this to happen. So, you know, there's no other reason than that. So that's all. It's a technical signal, and that's it. We already know that the stock is already a short sale target, and it's acting very weakly. So now we just use this to enter a position today. That's all. Why is it a sell signal? I'm feeling like I should bring up my Fifth Dimension song when the moon is in the 7th house and Jupiter aligns with Mars. Baidu. I think Baidu's a short. This is probably a shortable gap thing. You know, it's hit this level 1, 2, 3 times, and if it breaks the third time, it's gone. So we'll see what happens. It has held every time. Usually the third time fakes everybody out. So we'll just kind of see how this goes. It may, you know, using that as your stop right there, then you might be able to short it here using that 110.50 as your stop, and that's pretty tight. That's like 3% from here. So, and for the person who's just utterly confused about why something might be a sell signal, you can see here, again, there's the breakdown this morning, so you could have shorted it there. And what I'll do now is if it starts to get up to these levels, I'm using 107 as my trailing stop. You know, you could have covered here on the crossover back up and just to back away if you wanted to, but that's just what I'll use to guide me and keep me within a very tight band. So, but we already know, number one, I'm only using this on stocks that I already identify as a short sale target. And I have a maximum upside stop on a daily chart on that basis. So somebody said, do you see 105, 40 hours there where you would come in harder? What will it take to blow the bottom out of this pattern and take it to 100? I guess what it's going to take is a lot more sellers. And I think you possibly could come in and short it and tighten this up even more by using the high of the day at 107.90 as a stop. So, you know, it's vulnerable, and it's going to depend on what the market does. If the market doesn't blow apart, then this isn't going to blow apart. So, anyways, I hope by going through this, I'm helping those of you who are asking questions about, you know, why is this a sell signal and blah, blah, blah. Like there's some, you know, reason that God ordains that it's a sell signal. No, it's just, again, just a technical tool that I'm using on a 5-minute chart to time short sales on an intraday basis. ISRG. You know, I have to tell you, I have tested ISRG every time it comes up to this 550 level up around there, 549 yesterday. I've shorted it and it gets pinged, but it's not really breaking down, so I'm not sure this is a short sale target you want to mess with. However, you know, here's what the weekly chart looks like. So you got one wave down, 2 waves down. Here you are on a peak. You're running into resistance here. Price line looks a lot like this. I'm going to guess that if the market blows apart, then you're going to see the same thing happen with these stocks. But that said, I would prefer to be going after some of the weaker patterns, which is Google, which is Apple, and Apple's critical in that this line, this 40-week line, you can look at the chart. Every time it's come down to this line since the bottom in 2009 when it took off, it has found support at or around. There was a 6% dive below back here in, I think it was June of 2011, and then it came out and broke out. That was a shakeout. But for the most part, it has held this line. Now, if this thing blows right through it, you know, look out below. This thing could be top. I actually think Apple has topped for good, and I'm going to continue to play it that way until further notice. But, you know, the story is rosy. The stock is bulletproof. Supposedly nothing ever bad can ever happen to the company. They just dominate everywhere. But the law of large numbers is now working against this company, and you're starting to see it come under distribution by some of the big axes in the stock, such as Fidelity and the Fidelity Contra Fund. And I know that Will Danoff was beginning to accumulate Apple back in 2004 when we were first buying it at O'Neill. And I know these guys, you know, they're going to hold their stocks 5 years. You know, when it starts to get that long in the tooth, and now it's what? It's been 8 years since then, they're going to start distributing. I noticed in the last numbers that they've been steadily dumping the stock. Failed at the 700 level. Jesse Livermore would use that as a reverse century mark short sale signal, and it tells you that you know, that the stock's got some problems here. So we're seeing it, you know, try to push lower. It's trying to hold the 200-day. You probably pick up some buyers, but I can tell you another thing. Institutional investors, when they're dumping stock, they know that they can use the moving averages to their advantage. So if a stock comes down to the 200-day, if they're interested in accumulating, you'll see the volume come in, and they'll push it up off the line. But a lot of times what they'll do is they'll just back off on their selling, let the thing lift, to bring in the suckers who all see it as a bounce off the 200-day, because if you're not seeing any volume in it, though, you should not really be buying it. You need to see some volume off the 200-day to confirm that institutions are supporting there. When you don't, like you did yesterday, you know, we'll look at the daily chart here of Apple, you didn't really see any volume yesterday on the bounce, so the institutions are just using the little bounce to keep shuffling stock out the door, and that's what it seems like to me. So I think the stock is about to break the 200-day. I'm watching it very closely today. Maybe the high at 596.95 becomes your you know, last stop. if it does start to bounce. But right now this thing is really weak. So does SWI look like a head and shoulders? It's got that look. You got a left shoulder here, and this would be your big head. So now you're forming a right shoulder. You'd look for it to come up to 54.99, maybe somewhere in between here and there, where it's trading right now, and the 50-day or the 10-week moving average here. But it's starting to have that look, so it might be. But I think the one problem for me on this stock, let me get this 5-minute chart out of the way, is yeah, actually that. Notice how it's rallying up to the 65-day exponential, the black line. It trades less than 1 million shares a day, so that's one reason I would tend to shy away from the stock, to tell you the truth. So as a short sale target. Somebody said they couldn't borrow Lulu, so yeah, LinkedIn. I thought that was another. I couldn't borrow LinkedIn. I thought it was a short this morning on the news. They're great numbers and everything, but to me, I don't think that the market is going to support high multiple stocks right now, and that's generally what happens is the high multiple stocks start to come apart, and they really can't sustain any moves because the market is in a distributive phase, and so I couldn't borrow this one. Someone else tried to short Lulu, and they couldn't borrow that. That will become a problem. I've even noticed on some days we can easy borrow Apple, and on other days we have to actually go in and request it and go through the system. And I'm not sure why that happens, but there may be just rushes to borrow stock at certain times and they become unavailable. You may continue to try the Lulu. If I look at my Lulu readout right now, let's see. I'm pulling it up on my level 2 order screen right now. I can actually short that, and it is a easy borrow at JP Morgan, which is where we trade. So anyways, let's see. Let's keep going down on these questions. FXI. The FTSE, the Chinese stocks are acting okay, so but I'm not really necessarily going to jump out and start buying it. So would you be buying that, Dr. K? Someone asked, do we think this is viable? Hell no. What do you say?
It's not something I'm interested in. No, it's kind of it's weak.
Yeah.
And the world is still largely a recession, or recessions of varying sorts.
Yeah.
Risky.
And China as well, but this market's been trying to come back. But on a weekly chart, where are you really? You're in this overall bear market, and you're in a bear market rally within what I think is an overall bear market on a weekly chart. So I'm not a buyer here. Somebody says, what do you like most, MACD, divergence, stochastic? I don't know. I just use these two things on my 5-minute chart because it's just mess around with, and it's what I found actually works on some of these. So that's why there's nothing really particular about it. I think, though, what's going on right now, and the reason this does work, is because the market is in sort of a choppy, oscillating type of phase, so it gets overbought and oversold. And whenever it does, one way or the other, it generally snaps back because it's just a big QE market where the QE fairy comes in and sprinkles QE pixie dust every once in a while to push the markets up, and there's nothing really sustaining it in terms of the long-term accumulation of stocks by institutional investors. So I think that's why this works, and I think you can, like I was telling you guys last week, you can go mess around with a number of these sorts of oscillator-type indicators. You might come up with something similar. So to me, it's just a way for me to keep risk controlled. So, and I would review last week's video for more discussion on the way I was using this. But it's just something I'm using. And like I said, I'm afraid to show anybody this because now somebody wants to apply it in some broader way, and I get a million sort of meaningless questions, and sometimes you just confuse people. So Commvault, yeah, it's breaking out, but I'm not a buyer. So somebody makes a good point. It says, I'm definitely an amateur, they say, but some of these questions are redundant and seem to be coming from people that are using the service as a crutch and not a tool. That's a good point, and I think, taking that in the best spirit, rather than using it to slam somebody, I would say, think about this. If you are, and what you're looking for is some sort of absolute answer from us, I'm trying to point out how I control risk on the short side using this 5-minute chart. And somebody's trying to turn it into like this general buy and sell system that has some rationale that's beyond just the short-term technicals and a way to just collar things in order to limit risk. And so I think if you're trying to look at things that way, then that's probably not the right way to be looking at things, and you want to kind of back away from this idea of using us as a crutch. Because can tell you for sure that that's not a very good idea. I make a very bad crutch. Right, Dr. K? Dr. K's tried to use me as a crutch before, but
Have I? Was I drunk?
yeah, well, you don't remember that 10 martini night? So anyways,
Yeah, some of your martinis. That's the culprit.
I collapsed right along with you, so I didn't really make a very good crutch. So anyways, is the gold and silver weakness a precursor to more market weakness? I think this is the weakness in gold and silver. And you can see here's another gap down in the GLD and another gap down in the SLV, and now it's at the 200-day moving average. I think it's telling you that QE eternity, as we've been calling it, is really not helping things. And the market is beginning to discount perhaps the end of QE, and we talked about this last week.
Yeah, so there's a counter argument. That's a possibility. That the counter argument is that European officials are trying to suppress any negative news because they want to increase the odds of Obama being reelected, and since the election is so close, and it seems like the euro is coming under some fire here in the meantime. So it seems like there's some big money that's shorting the euro and also selling off the precious metals. While it awaits the election results, and then after, if this theory is correct, after the election, then Europe's going to come out with its negative news, and the markets are going to get hit, and of course, then it's at that point QE will come aboard if there is any serious cover-up going on. But that's the theory, and it's an interesting one.
It is. So everybody's providing cover for Obama. So I even noticed the media making it sound like the post-hurricane situation is all buttoned up and everything's, Obama's done the presidential thing and taken care of business and made sure everything's okay. But having people on the ground over there in our family, we know that that's not the case, and things are still looking pretty grim. And it's almost like this is New York's Katrina, as some people have pointed out. But the media certainly is not blowing it up like they did with Katrina, but that's because there isn't a Republican in the White House. So it's just kind of interesting how they don't do their job. But it's tough when you have a disaster this huge. It shows that government resources are limited as well, and I think that they did. Unlike Katrina, where you had thousands of buses sitting in parking lots that could have been used to get people out of town and evacuated, the New Yorkers did pretty much everything they could. But all those low-lying areas along Long Island, I've been to Southampton, and I got to tell you, even when I go out to Malibu and I see some of these big houses on Malibu Colony, where I was out in front of Jim Carrey's house out there, and these huge houses, but what they have are these huge retaining walls, and the high tide, the waves are hitting the retaining walls and coming over the wall and splashing onto the back decks of these houses. And being next to the ocean, I live on a plateau or bluff overlooking the ocean, so I'm kind of immune from that. But I do think about that. It's amazing that people have built all these structures right along the flatlands along an ocean where anything can happen, and so it can, and it has. But it seems like they did everything they could to prepare for it, and it's still tough. Financials are one of the few areas of the market that are acting okay. They are. Goldman Sachs are acting okay, but Wells Fargo not acting okay. The XLF is kind of holding out on the base, but as far as I'm concerned, this could just be the next thing to blow to the downside. So I'm not going to look to find any comfort in the financials. What do you think the relative strength of the financials means, Dr. K?
That's a good question. I mean, it's still relative. I mean, if you look at what Apple has done, and Apple looks like it may have topped. That's dragging down the technology stocks. A lot of tech stocks other than Apple are also getting hit on weak earnings. So that's dragging down the NASDAQ and any related average. Meanwhile, the XLF is pretty inert to whatever the tech world does. So I think it's representative of what is going on outside of technology. But the problem here is that technology often leads the market. So if tech's going to go down, if Apple's going to bust through its 200-day, it's going to take the rest of the market with it, including XLF.
Oh, I'm back. Sorry. Audio didn't go dead there. It actually, I had my mic off. But you're seeing here, what was that, Dr. K, what was that Texas Bank, TCBI, is that it? Or
Yeah,
yeah.
TCBI.
Seeing this one start to break down, but you know, as I was going through, when my mic was off, you could see some of the charts I'm looking at. You know, Goldman Sachs, Bank of America, Citigroup, those are acting pretty well. But you know, some of these other things like these property groups, PPG, reversing today. No, that's not it. I'm thinking of SPG. Boy, got to keep this straight. It's trying to rally today, but it's been breaking down as well. And a lot of these look tenuous, so I'm not really sure that you want to be buying financials. No, I'm not tempted to buy any of those stocks. So we're in a downtrend. I don't, you know, I don't really try to sit and figure out, do I want to buy this or that? The market's in a downtrend. I just want to avoid stocks, as far as I'm concerned. I'm more interested on the short side, and I have to tell you, that's what's been giving me the most love. I mean, you can go ahead and try and buy Goldman Sachs here, but where do you buy it? Here's like a breakout from a very large cup and handle type thing, but it failed on that. Now it's double topping here, weak volume. Why would you bother? I think it's kind of stretching it, and I think when you have to stretch it on the buy side to look for ideas like that, I think that's telling you something about the market. Somebody was able to short Lulu, so glad to know somebody could borrow it. I can borrow it. I'm watching it. I could have shorted earlier, but I've been focusing on these big stocks. Herbalife looks like it's trying to break down, and I think it will, because this is a big, ugly head and shoulders, and it's just taken a long time for it to set up. So I think that this could be shortable using the high at 51.53 today, at the peak 3% higher as your stop. That's a possible trade right here if the market breaks down. Of course, that's going to depend on the market breaking down, but you can see the pattern is starting to get there, and it's been hitting my radar screen because it is long in the tooth in terms of forming enough right shoulders. You know, basically, I'm going to say here's like a mini rally here. It's a right shoulder, and then 1, 2, and here's your third one that it's forming now. It can't get above the 200-day or 40-week moving average. I think that's still pretty weak. So let's see. Have you ever used the inverse ETS for gold and silver when the charts look weak? I haven't, but I know people who have, and in some cases they've done pretty well with that, and that's one way to play them. So CMG, everybody's always asking that. It stock's way down there, so I think some of these more fresher opportunities are better, but you can see it could continue up to 280 on the daily chart to fill this gap. It seems to be dying here, so maybe you could try and use the 20-day, the green line here, as a stop. I don't know. It is a wedging rally, but it's not clear to me how far it goes higher. It does seem that if it got to 280, that would be the best spot to be shorting it optimally. I'd love to see it rally up there, and then I might look at it. But right now it's kind of in no man's land, but it could give it up today, but who knows. The way to handle this, if you were looking to hit it here, if you think it's this as far as it's going, then what you would want to do is short it here using the high at 268.27 as a stop, which is about 2% higher, I believe, somewhere around there. Yeah. Please comment on the housing sector. Well, I'm not a buyer of housing stocks. I think, you know, some of these looked pretty good. Toll Brothers, PHM, Pulte, you know, but do they really go anywhere? They had their best move back here, and now everybody's on to them. You know, some of these other stocks on the Katrina, actually the Hurricane Sandy news, are starting to look a little bit double toppy. So I'm not really going to play them, and I don't really think that there's a long-term play. I still think the housing sector is grossly overvalued, and I think that there is a second bubble in housing because it's all being propped up by QE in the short term. And I think you just have a big bubble there that still has not wound itself out. I don't believe. If I get into the macros of it all, I still think you have a big bubble being created by all this QE, and that's all the Fed has done is inflate this big bubble. And it's going to be very interesting to see how they begin to deflate it, or if the whole thing just bursts on its own. And that's why I'm very wary of the long side, and you know, being long anything. I mean, gold or silver as well. So. Somebody says I'm not trying to be mean. I thought I was trying to be mean. Any thoughts on Sandy rebuild plays? Dr. K, you want to comment on something like that, which I think is interesting? This whole concept of trying to play the news.
Well, yeah, I mean, in general, the price volume action will tell you all you need to know rather than trying to guess the future, which doesn't exist. So, whatever happens out of Sandy, we're going to start to see a movement in that type of sector that is benefiting from Sandy, or in an individual stock that maybe has a viable gap up or some strong price volume action. We'll see it. We'll see it in our screens come through, so we don't have to hypothesize about which sector is going to benefit from various news occurrences. Your mic went off again?
Anyways, yeah, I keep turning off and forgetting to put it back on. So, but anyways, all I'm saying is that I don't think playing the news like this, to me, it's very Kramer-esque to say, oh, there's a hurricane coming, or here's a hurricane, and you got to buy battery companies and generator companies and all this other stuff. There's no move that's ever started in a group on the basis of hurricane damage or any kind of natural disaster, other than the defense stocks starting a big move after 9/11, but there was a broader issue there, which was us going to a war footing at the time. Anyways.
Well, also that one particular stock then was bucking the trend and showing all the strong technical signs that it should be bought. So it was screaming buy at that point. And right now we're not seeing any screaming buys.
No, and the screaming buy this morning turned out to be more of a crying buy, or a different type of screaming buy. But someone says it's a short-term target for cores 53.14. I don't know. I don't know what the target is here. What I'm looking for is if the market fails, maybe it just blasts through its 50-day moving average. I have no idea. It could turn out to just be a day trade. So I don't really have any target in mind right now. And it's really not a typical short sale setup, but I am illustrating how I can even use this short-term model to just short something very quickly. So I'm thinking about getting a job at a day trading firm and just doing this and day trading. And that'll work for another month, and then the whole QE thing will come unwound and it won't work anymore. URI, I noticed rental stocks have been moving, but the idea there is that people being forced out of their homes and trying to recoup and rebuild, they're going to have to move their stuff into rental areas. Again, it's the same type of play. I don't know. Maybe if Obama is reelected and the economy gets so bad that the only place people will be able to afford to live will be in rental storage areas. So somebody is saying the break in gold and silver might be forecasting a Romney win. Now we've talked about how Romney has said that he will, in fact, he would let Bernanke go and end this quantitative easing, but we would remind everyone that Bernanke's term ends in 2014. But you're right, though. The market could be discounting or starting to discount the end of QE. So what are your views on growth stocks losing multiple power now? I think I pointed that out, and I think that was a situation with LinkedIn, which is, I don't know, what's it selling at these days, Dr. K? Not that there's anything you look at, but 88 times forward estimates. In this market, in a bear market, the multiples will contract. So by definition, if we get into a bear market, multiples will contract. And the stock, to me, the way it's acting right now, looks extremely shortable. And like it's just going to blow apart and head right to the 200-day. And I think if you see Apple head lower, that's probably going to take it with it. So it's another one that probably can be shorted for those of you who are brave. Using a pretty tight stop. I think if you short it here and use the high of the day as a stop, that gives you a lot of room, but that's probably more than I would want to give it. I'd probably give it to the 65-day, which is around 110, a little bit above. Seems a lot of gap ups and then hard fading even on good EPS releases. Yeah, that's true, and that's the general idea behind a bear market, is that you will see up openings will fail, whereas in a bull market, down openings will reverse and resolve back to the upside. That's one of the reasons this little short-term gizmo on the 5-minute chart that I use works so well, and you can see it worked on LinkedIn this morning, and it still is showing us another sell signal here. So I would even add sometimes if I was short and it fails again and I held through this little blip above, I may add on something like that. And that's kind of what I'm looking at right now in Apple. Since I'm short up in here, it comes down, I'll add in here, and I did, and now I'm watching this. If it breaks away again, I may add again. So that's how I'll play it. And then, of course, if the thing gets a real strong buy signal and the market turns, generally, then I'll be covering and getting out of the way very quickly. So, but this all plays on the idea also that in a bear market, stocks in the market will open up and then reverse, and this is a way to catch it. Well, giving yourself a quick mechanism or a mechanism for a quick exit stage right is Yogi Bear, one of the world's famous bears. I don't think he ever invested in the markets, but I'm sure if he did, he would have been a short seller. But as Yogi Bear would say, exit stage right. Dr. K, you gave, some people say, oh, I went through Katrina. No, in southern Mississippi, we're still rebuilding 4 and 5 years later, even now. New York and New Jersey still have a long time to go. Right, and I would point out that even though Katrina took 4 or 5 years to build, did that result in a big bull market in housing stocks and other things? No, not necessarily. Someone's asking about your UVXY, which is you now call the what? The TVIX model, Dr. K? They're asking what will you be...
I just simplified it to UVXY. I mean, they're both aggressive instruments, and they're both correlated, inversely correlated to market direction by a factor of 2. Compared to, say, VXX, which is correlated, negatively correlated by a factor of 1, and then you've got the XIV, which is the inverse of these. Therefore, it's positively correlated with the markets.
Okay, and what's the VIX doing today? Is it actually? Let me take a look here. Where are you, VIX? Come back. Here we are. Down. It's down today. So, Dr. K, what would it take to, what will you be looking for to issue a buy signal on UVXY? Actions of leading stocks breaking down further?
No, well, the UVXY model is more of a short-term model. Not necessarily, but it's more of a short-term, so it's looking at volatility indications, whereas the market direction model is looking at the price volume action of leading stocks and major indices. So they're two different animals. However, there's going to be overlap, such as if we were to get a very strong selling pressure in the market or buying pressure, either way, and the MDM were to go to a buy signal or a sell signal, as the case may be, then the UVXY model would probably also issue a signal. But the signal has to be pretty strong and confirming for both models to issue signals at the same time. In practice, I think the UVXY model, it's going to be a shorter-term model, so it's going to wiggle around more than, it's not designed to catch, necessarily the long-term, or I should say downtrends in the market, because downtrends are very short and sharp, and while it's capable of catching those, it's not looking to catch the whole move. It's looking to get in and then get out, take profits fairly quickly, as it did with this last buy signal it had on UVXY. It was a fairly short signal, as you all might have noticed, and the profits in that signal were as high as, I believe, 24%, and then all it took was the early morning trading to reverse that down to a 16% profit. So as you can see, these instruments are quite volatile, and you have to be quick on the trigger.
Yeah, and one way to trade them intraday is using this 5-minute chart. Here's a buy signal, here's a sell signal. So if you had bought into it this morning with the idea that the market rolling over, then you could have bought on this signal here, and then this would have gotten you out up here, and you would have avoided this. This is another way you can use this little 5-minute gizmo. And like I said, you guys can play around with other oscillator indicators, because I'm just using the MACD and basically that's it, and some moving average stuff, and that's really it. And that's kind of an oscillator as well, so it tells you when things are at extremes and when they might be bouncing back. So that's one way to trade it. I can tell you this much this morning, that I bought the 3x inverse S&P on this buy signal. Here, you can see the cross this morning right about the opening, and so watching that, I just went ahead and bought it up here. I think I'm in at like 38.70, if I'm right there. Yeah, that's right. I'm in at 38.70, so I got in right about here as it was coming up and through here, and I've stayed long this because even though you get this little sell signal here, to me, I'm up far enough that it needs to come down further for me to really bail out. So I'll give it a little bit of wiggle room. But notice how it's starting to turn back to the upside, so I might double the position on this breakout, and it may be telling you that we're headed lower. But that's another way to use this little model, and we kind of applied it to ETFs But it really started out as something that I created to control my risk on the short side and also to give me reasonable entry points trying to short into rallies, with the idea that it also provides me with a very quick out signal if the thing goes against me. Because one of the problems I found with shorting rallies is that you can try and short the rally, and it's great when it works, but sometimes, you know, let's look at, say, Google, for example. Sometimes they just keep going against you. And yesterday, you know, you've got a rally here, so I'll try and short into it, but sometime during the middle of the day, I believe it gave me a get the hell out of Dodge signal. And I think that was down here because it did start to, let's see, yesterday was what, the 1st? It did start to say, you know, short me here. So I remember shorting it here, and then by the end of the day, we just bailed out of it right around these levels because it closed right around here because it wasn't really giving me anything real clear here. And this morning now, you open up, and now you're rolling over, and here you are starting to roll over again. So if it does this here, this may be my second signal to short even more. We'll see what happens. But I'm already short, you know, I don't know, 4,000 shares of the thing, so I've got a pretty good sized position if it blows apart. Somebody asked, why does Amazon, we're going to wrap up here in about 5 minutes, why does Amazon have such a high PE? Amazon has always had a high PE because they're doing this spend to grow sort of thing where they're spending money building out their infrastructure and taking losses in the short term while they build out for all this growth later on. That could backfire, and I just watched the stock. I think the stock's starting to break down. It came down. Here's this breakout point here, and you'll notice it came right down there and kind of cut through it a little bit, so it's failing. I wouldn't be surprised if the stock rolled over back down to the 200-day from here. If you wanted to short it here using the high today at 237.40 as your guide for a stop. Pretty simple. How do you balance between using the 7-week rule versus using the MDM model? Well, the market direction model is just a market direction model, and it's basically telling you, trying to pick up the general direction of the general market, the general trend rather. The 7-week rule applies to the specific stock, so it's not really anything that is combined with the MDM, right, Dr. K?
Yeah, essentially, we talk about this in the FAQs, but if let's say the model's on a sell signal, but you're sitting in a position on the long side, you don't have to just sell it out. You can wait for that stock to violate the 7-week rule and then sell it out, because sometimes what happens is a strong stock can buck the trend. Also, the model is certainly capable of giving false signals, and so if it's a false signal, the market might go higher shortly thereafter the signal's issued. So you want to use the 7-week rule strictly for the positioning in stocks in terms of guiding your sells in various stocks in your portfolio. It's a rule I've found keeps me in winning names the longest. And as you all know, you can read up on this on our website, and it has to do with utilizing the 10-day and the 50-day moving average in terms of issuing sell signals. And you can also, you can of course always, you can use, it's just like with pyramiding, you can also pyramid out of a position. Just because you have a sell signal, say on the 10-day moving average, doesn't mean you have to sell the whole thing. You could sell half of it and then wait to see if the stock were to go lower, you can sell the other half. So there's lots of ways to negotiate it.
I'm actually ashamed here that I got my cartoon history wrong. It wasn't Yogi Bear who said exit stage right or exit stage left. It was Snagglepuss, who was not a bear. He was what was he, a lion or some sort of bear?
Yeah, he was some kind of lion cat family.
Someone's wondering a separate video on the short-term model. No, I'm not going to really get into it. I mean, I've explained it on this thing on the last week's video and this one, so it's pretty simple. But like I said, it's just something I devised, and you could probably devise something similarly your own. If you don't have enough experience as a trader to devise something like this yourself, then you're probably better off not trying to use it. Somebody says, I started using your 5-minute chart a couple days, and it helped me reverse out of cores this morning with tiny loss and very little thinking. That's what you want. The new book is on pre-sale on Amazon. It is, and which, I don't know, I think steals, somebody said Huckleberry Hound said exit. Say, no, it's Snagglepuss. See, there's another person. But you know what? We're all dating ourselves by remembering these old cartoon characters. But anyways, I'm just a grouch in any case. And I get really obnoxious when I'm making money, so just in case anybody's wondering. Okay, so what else we got going on here? Let me kind of drop this down here. That's pretty much all the questions. So I'm going to blow out of these charts here, as you can see my screen. and just kind of surveying to cover things. What's down big? SSY. This is was my buy list. It's kind of a list of leaders and former leaders and whatnot. Whatever happened to Vivus? Remember Vivus? Oh boy. Here was a housing stock that was acting well. Fortune Brands and trying to break out today, but this kind of V-shaped thing isn't really happening. But you can see real quick, I keep this on my screen. I basically have my short lists over here, some ETFs over here. I got my buy ideas here, what were the leaders, and a number of it. If I just go through this, I'm not going to do that now, but if I go through these stocks, a lot of these are getting hammered. You got some things pushing higher. Equix is trying to push up through the 50-day moving average today. It's on earnings, but I wouldn't be buying that. And you can see some of the other stocks in Exion, I think that is how do you pronounce that? Interzion or something, Holdings, trying to come up, sort of a pocket pivot off the 50-day yesterday. You can see down here in my chart. But those are trying to move today. Other than that, you don't have very much. Everything that's bouncing is less than 1%. Everything that's down is down a fair bit here. So running through some of the names on my short sale list, somebody asked about Priceline as a short. It's possible it could be. So I've watched this here. If you really want to come after, use 657.60 high. You're at 644.38 now, so you've come in a bit. But it can hold this peak. I think we talked about this in this morning's what do we call that? Pre-market pulse, and that it is reaching its peak. So it's possible this could be shortable if you're bold. You might wait for some confirmation, but it could very well be. So let's see. Anything else? What is with Chris Catcher's talk tomorrow? Well, I think I'll finish out on that note. There is a Wounded Warrior Project benefit going on, and it's put on by Diversified Trading Institute, for whom we have done some workshops in the past online. Some of you may have attended some of those, DTI. And tomorrow they're hosting these 10-minute cameo appearances, I guess, by traders, well-known traders. I'm going to be at a soccer game in the morning, so I'm not going to be able to participate, but Dr. K will be on. So you're going to run through a lot of big-name, allegedly big-name traders, and each person is going to take 10 minutes to talk about number one, the biggest lesson that they've had in their career, and what that was all about, and also their outlook for the future. Now, remember, we don't operate on the basis of an outlook for the future. We just watch and see what the market's doing right now. So I don't know if Dr. K is going to be able to pontificate on that. It seems like a very short amount of time, doesn't it, Dr. K?
It's a short amount of time, so yeah, I've had to cut it down to the basics, and yeah, the future does not exist, and I start out by saying just that, but I do have a few things to say nevertheless.
Yeah, but all the media sources, we get calls from our publicist, who's great. I got to say, Darlene is great, and she's gotten us on a lot of places. But she'll come around and ask you, "What do you guys? These are the hot topics right now. What do you guys think about this and this?" And it's always, "What's going to happen after the election?" And who knows? To me, it's like, what's happening right now? That's what I'm more interested in, and I'll operate on that basis until further notice. So I try to give you guys some insight into what I'm doing, how I handle the short side. We'll see how things pan out. My whole objective here is if we do get a break for the 200-day moving average on the NASDAQ, and this is going to come up without the correct volume, but don't worry about that. If we do get this breakdown through, I want to be positioned, and I think being the weakest index, it's weaker than the S&P, and we can also see that today the action in the S&P coincides with pushing right into the 50-day and reversing off of there. So if the volume picks up going into the close and things start to break down, then we may be in Fat City, at least on the short side, if this breaks down. And so I'm just using my little short-term timing entry and exit model to come in on the 5-minute chart and put out my positions in the hopes or trying to put myself in the position of scoring big time if we do break down and have a big down day through the 200-day moving average. So that's basically what I'm trying to do, and hopefully there's some insight or whatever it is that I was able to pass along in terms of how I approach the short side, at least right now. But I also want to emphasize that this evolves and it changes, and so a week from now I may not be using something like this, but it is what I've been using, and the only reason I bring it up is for those of you who are experienced traders and for those of you who have a good feel for the market and maybe have some experience on the short side, just trying to give you some ideas and how you might be able to handle some of the problems that you have on the short side, because any short seller will tell you what are the biggest problems you'll have, and that is that things will snap back in your face very quickly, or if you're shorting into a rally, how do you get in and know how to bail out very quickly if the rally just keeps coming up your nose? And that's the other issue, and that's what I've tried to address with this. And it's been what I devise. I'm sure, I know, like as we pointed out last week, a friend of ours who's on these webinars, Dave Eccles, he uses his own situation or his own little system to deal with his own situation on the short side. And even on the see him do some long trades and do pretty well in most cases. And they're very similar to what I'm doing. It's interesting he came up with a similar system at the same time. Perhaps that means that great minds do think alike, right, Dave? Anyways, another thing here is how do we figure out when, if the market does start to break down, how do we know when it's getting time to cover? And basically what you'll see is just a very big streak to the downside, a lot of panic, a lot of fear, the put-call ratios get very high, and you'll see your P&L and your accounts start to ratchet up very quickly. And it's usually when that happens, and I can see the net change on my account P&L just zooming to the upside, and I'm making money hand over fist, that is probably when you want to be covering, and it will generally happen at a logical area, either at a major undercut on the indices. I'm starting to see Google break down here. That's what I want to see. And I am pretty short there right now. Only 3,000 shares, but we may ramp it up if it starts to break down. No, I'm sorry, 4,000 shares. What am I looking at? That's Apple. I got 3,000 out on right now. But we'll see how these go, and I do want to be in a position to play that. Now, I do think if we do break down through the 200-day, you're looking at, on the 2850 area, somewhere down there is possibly where it all comes to an end. If that happens, and we'll just have to see how that goes. So basically, all I'm trying to do is, short into this rally in a reasonable way using my little short-term model here. And I know Dr. K uses a little longer. You use a sort of a derivative of this as well. It's similar, right, Dr. K? But it's a little bit different, and it's more attuned to the way he likes to trade too. I don't use
the MACD at all. I'm always striving for simplicity in my models, and so with the elimination of the MACD and still having statistical significance, I'm very pleased with the risk reward of this shorter term model. I mean, there's a longer term, and there's also the day trading version. The day trading version is just not practical for people to really be executing. But the longer term version, which is the one on selfish investing, also has an excellent risk reward profile. And the essence is simplicity. Just when you use moving average crossover, it's a very good Donchian system actually that has worked for a long time. But you have it's trickier than it looks. Just buying when you have a crossover and selling when you have another crossover. If it were only that easy and that simple, that would be pretty amazing. But I think someone would have already figured that out. And so it requires necessary fine-tuning of whatever moving averages you're looking at to create viable buy and sell rules that are statistically significant, not just in the down market, but also in up markets and sideways markets. And that's what my model has done over the months. I have fine-tuned it from its early days when it had a couple good signals and some pretty disastrous negative signals, and those have all been completely optimized. So far so good. We have had 2 very profitable signals on the UVXY model, and I would expect, based on what I've seen, hopefully this will continue, but time will tell.
Yeah, you can see that we're getting the NASDAQ composite itself is breaking down. Somebody asked last question, what is your ETF? If the NASDAQ is breaking down, what ETF do you want? Well, I'd say you can pretty much be long any inverse index ETF. But I think if the NASDAQ breaks down, you want to be along the SQQQ or is it the QID? Or you could do the Russell 2000 because that's similar to the NASDAQ and it'll generally tend to be weaker. So, anyways, that's all I've got. It looks like the market wants to head down another intraday leg, so I want to get out and get busy and tend to my positions here. So it looks like I'm moving to new highs on my P&L for the day. We'll see how this pans out. But it's still, it's all very fluid and it's all touch and go. So, and my main concern and my main objective right now is to limit risk if the market snaps to the upside, with the idea of putting myself in the position to play a break of the 200-day moving average on the NASDAQ index. Anyways, you guys, hope it was useful. If we do get into some hairy downside action, I may come on and do a short 20-minute intraday video over the next couple of days, so watch out for the emails for that if I decide to do it. And do something intraday so we can see what's going on. Maybe I can show you guys a few other things. with the idea not of giving you a crutch or providing you with a crutch, but of just exposing it as how I approach things, and maybe it inspires you to, or give you some ideas on how you can apply the same sort of thinking to your own trading in terms of trying to give yourself a fighting chance and at the same time control risk on the short side. And that's all I've got. Okay, you all done?
Yeah, it's all good.
Okay, everyone, thanks for showing up. We'll catch you next time. Take care.
So long, everyone.